Hi, everyone. I'm Ben Swett, the editor of the SeniorCare Investor, and today I'm joined by Ryan Saul of Senior Living Investment Brokerage, and we're going to talk about the current state of the SeniorCare M&A market today. It's January 2021. We just finished a unique year in 2020, and so we're here to get Ryan's insights. So welcome, Ryan.
Thanks for having me, Ben. Nice to be with you, and it was a unique year, definitely.
I'm sure a lot of lessons were learned, so I'm just going to dive in. It's something that I was curious about the whole year long, and now that 2020 is over, I feel like I can ask it. But what properties were coming to market in 2020 that weren't so common in 2019? And on the flip side, what properties were not as popular targets in 2020 when compared with 2019?
Sure. Well, in 19, we didn't see nearly the distress we did in 2020. Most of what we saw in the market and transacting was severely distressed. You saw negative trends, occupancy down, expenses up. So we saw a lot of distressed assets. Surprisingly, in 2020, you didn't see a lot of the 100% occupied ALIL cash flowing, low cap rate deals. There just was too much risk for a lot of the buyers. Even if buildings were fortunate enough not to be affected by COVID, you didn't really see a lot of those on the market just because buyers were fearful that those communities would be impacted and trying to figure out where the lending market was shaking out, where rates were going to shake out, where NOI was going to shake out. So you didn't see a lot. In 19 and before, you saw a lot of those stabilized, really low cap rate deals, and you did not see much of that in 2020.
Mm-hmm. I imagine that's going to have quite the impact on the average values in 2020, and we'll find out about those next month.
I think you're right.
So was there a particular sector that you noticed gained more investor attention in 2020 relative to the other sectors?
Yeah, well, obviously skilled nursing had the most attention. They were most impacted by COVID. They had the biggest obstacles to overcome. But as far as investor interest, your IL and your AL light communities really had the most attention, I would say. Mm-hmm. Everybody is keen on when that recovery is going to happen. You saw all these communities put a ban on admissions, and they were starving off COVID in their facilities, both trying to protect their staff and residents. And that's a product that is a choice to move in. So everybody's keen in on when is that recovery going to happen. But we did see a lot of groups looking for opportunities on communities in the AL and IL sector that are gaining a lot of attention.
Mm-hmm. And you think that'll continue into 2021 as well?
I do, yep. I do think that sector is going to have a lot of attention on it, and it's just a matter of when that recovery is going to happen, and I think that remains to be a big question mark. Yeah.
So you mentioned that I imagine most of your deals in 2020 involved some type of value add component or a turnaround property, and for those types of deals, I was wondering which type of buyer was more active. Was it the financial buyers or the more strategic buyers?
We really saw the strategic buyers come to the forefront. They were the private owners and the regional companies that are looking for consolidation plays, or they're looking for a deep discount for turnaround. The financial buyers largely sat on the sidelines or were divesting out of their portfolio assets that were a drain on their portfolio. So I think that trend will continue into 2021, that you'll see a lot more strategic buyers looking for opportunities.
Mm-hmm. That makes sense. I mean, it does seem like the opportunity of one's lifetime in 2020 to really start building up your regional portfolios. And exactly. I guess we'll see where the price discounting ends up for 2020 and you know whether they were able to get in at a pretty low basis.
Yep.
Yeah. Well, speaking of price discounting and price reductions due to COVID, I was curious, in what cases did you actually see a reduction in price for a property due to COVID?
Sure. Well, in the past, what we usually saw is reduction in purchase price related to property condition. Really, where we saw the decrease in price was related to loss of staff.
Mm-hmm.
Pre-COVID pandemic, staffing was already an issue, right? So you throw into COVID, and staffing just becomes that much more difficult. You lose key staff, and that changes the whole dynamic of a community. So in those instances when there was a loss of staff, we saw an adjustment accordingly, knowing that it was going to take significant dollars to rebuild that labor force. And then obviously, a significant census drop obviously translated into a price reduction for our property. So those two incidents, normally we try to see if it's just a temporary adjustment in occupancy or census. If COVID happens to run through a building, we did see a number of cases that they developed almost herd immunity within their community and were able to rebound from a bottom after a spread of COVID. So we didn't see as much significant pricing adjustments when we were able to see a rebound in census.
Mm-hmm. In the properties you were working on, just regarding the staff, was it mostly local communities that were poaching those key staff, or were they leaving the sector? Did you notice any particular trend?
That's a great question, Ben. And sadly, it was a case in a lot of the assets we were working on, labor force leaving the sector. They were older administrators, older DONs, older high-level key staff that just said, I'm not putting myself at risk and I'm not putting my family at risk. So we had a number of transactions that sadly just had good quality key people that were in it for the mission that just said, I can't do it anymore. So it's a high level. You're not even talking about the care level staff. We saw a lot of key leadership and management positions just say, this isn't what I signed up for.
Mm-hmm. Gosh, I mean, let's hope that it's not a permanent exit for a lot of them.
I agree.
That does not bode well for the sector.
No, exactly. And I do think that, the future is bright, right? Mm-hmm. I think that once things are stabilized, and we all know that staff in this industry, they're in it because it's their passion. I do think that once things are stabilized, the vaccine is effective, and the risk is removed, I do think that you'll see more come back to the sector.
Mm-hmm. Going back to the price discounting, apples to apples, the same facility that would have sold in 2019 that sold in 2020, what kind of discount did you see for that property in 2020?
Yeah, that's a great question. And right, it's a loaded question from the standpoint of it. It really depends on the circumstances. In the highly distressed situations, even apples to apples, you might have seen a 30% reduction. But I think on average, from 19 to 20, you probably saw a 10 to 15% reduction on an asset, just apples to apples.
Mm-hmm. Okay. Yeah, that seems to match up with what we've been hearing around on the ground, but
yeah,
it certainly can vary a lot wider than that.
Exactly. That's what we find as well.
Yeah. So you had a successful year in 2020 despite all the hurdles. And what we've been hearing from brokers is they've had to get creative to get deals done these days. But what does creative mean to you?
Yeah, creative is right in 2020. And thankfully in 2021, we won't hopefully have to be as creative. The real stumbling block was the third parties and the visits, right? And so we did have to get creative, and thankfully to see communities and inspect them, the Zoom and FaceTime tours worked well. Both buyers and sellers and lenders were okay with that new creative way to actually see properties. Mm-hmm. And then also, on mechanicals, it turned into a situation that a lot of these have maintenance contracts or are serviced. So a lot of on the physical plant and functioning of the buildings, you relied on a lot of the third-party mechanical vendors that were in the community. So that took some creativity. Also, in a lot of these transactions, you have a built-in material and adverse change clause. In the uncertain times, everybody's putting a lot of time and money into getting these transactions done. Mm-hmm. So what we found is you didn't want to spend all this time and money, have COVID hit a building, and then pull the plug transactions off, and everybody just wasted a lot of time and effort. Mm-hmm. So to get creative, what we've seen in a few transactions is you put a built-in formula for a material and adverse change clause. You apply what that means if a certain number of residents or percentage of occupancy drops, so that you can still close a number that the buyer is comfortable with and a number that the seller would be comfortable with on the front end.
Mm-hmm.
Those are just a couple things.
Interesting. So just maximize the communication between all parties throughout the whole sales process. That seems to have helped.
It did, yep. And that's what it took to get transactions done, for sure.
Yeah. Well, it also took lending, and we know that was quite difficult to obtain for most of 2020. And I was just wondering, what were lenders exactly looking for from buyers that they were not in 2019?
Well, thankfully, Ben, you hit it right on. It all hinges on the lending, right? And thankfully, the lenders stuck in there in 2020 and were able to partner with their operators and their borrowers to grow. But it did see some pain. It definitely saw pain for borrowers, but lenders were protecting their investment and protecting the risk. So we saw much more equity that had to be thrown into a deal, more guarantees on the lending side. And then we also saw more kind of debt reserve escrow amounts. Mm-hmm. So at the end of the day, I think if we would have had any live conferences in 2020, gone are the days when an operator or buyer would go to a conference and say, hey, I have a deal, and have 30 lenders line up wanting to give them term sheets. Mm-hmm. So that scenario was gone, but we did see lenders partner with their good operators, and you had fewer to choose from, but they were good partners. Mm-hmm. And just both sides had to understand that they were trying to mitigate potential risk. And so unfortunately, it has required borrowers to come up with more equity and put more cash into deals. But I don't think necessarily that's a bad thing for the industry as a whole. It just makes it a little bit more challenging for the buying power of the borrower.
Yeah. Yeah, not as many green lanyards walking around at the NIC this year.
Right.
But like you said, that's not necessarily a bad thing. Lenders being more conservative, buyers required to put more equity up front. That seems to be a good long-term prospect for the industry. Not as many deals may get done at the prices that they want, but there needs to be some kind of valuation reset, especially after a year like this.
I think you're right.
Yeah, and with the upcoming Biden administration coming in, that means that a second round of stimulus seems pretty likely in the first quarter of 2021. And the government relief and stimulus helped keep many senior care facilities in business in 2020, but we also imagine it kept a lot of owners on the M&A sidelines. Since cash was coming in, why sell now, especially at a likely price discount? So I was wondering, how will a second round of stimulus affect M&A in 2021, in your opinion?
Yeah, Ben, that's a great point, and I think it's good that you bring that up because, like you said, on the ground, that's what we're hearing, and we're talking to owners and operators every day, both buyers and sellers, and we have had that comment to us from a number of sellers. Hey, I'm getting stimulus, I'm doing okay. I'm just trying to keep my head above water and fend off this disease. Mm-hmm. So that has put a stall in the market of some sellers. I do think the second round of stimulus will delay inventory a bit. I do think that we'll start seeing a flood of inventory, maybe the end of second quarter, when the stimulus money, I won't want to call it dried up, right? But when it slows down and stops, and the owners have to take a really hard look in the mirror and look around them in their facility, I do think that's going to drive a lot of sales. And thankfully, I do think it's going to be a surge or a big wave of M&A because, Ben, there is so much money on the sidelines and so many buyers just waiting to pounce on opportunities. They just don't have their pick of the opportunities on the market right now. There's deals out there, but it's just not the wave that everybody expected. But I do think that the wave of inventory will be met with equal demand.
That's good to hear. That bodes well for 2021 for people like you and me.
It does. It just might be a slow start, right? I think we will start seeing the activity kind of towards the end of the second quarter, which should lead to, we're anticipating and hopeful for a very busy 2021, although it's obviously going to be choppy. The curveballs and sliders and knuckleballs are going to be thrown at us all along the way. But I do think both buyers and sellers are committed to wanting to get deals transacted.
Well, knuckleballs and curveballs and sliders may answer my last question for you, Ryan, but what do you think will be the theme of 2021 M&A in the senior care market?
Yeah, I do think it's going to be distressed sales. Occupancy has obviously been hit. Again, expenses have gone up. We're gonna see a number of distressed sales come to market, and I do think that there's opportunity out there for buyers to consolidate and to acquire in their region. I also think kind of the theme will be recovery, right? How quickly will things stabilize and improve? And I think that's going to be on the forefront of everybody's mind, wanting to time, and nobody can ever time the market, right? But you're going to want to time it to when we start seeing the positive increases and positive trends in the occupancy.
Mm-hmm. And I mean, we'll see if 2021 is even the year of recovery for this industry, but that's not even certain at this point.
Correct. Right. I just want to start seeing some improvement toward recovery. Yep.
Yeah. Well, I guess that kind of ended on somewhat of a sour note, but I think we both have hope that at some point in 2021, things may start to look up for the industry. And I guess that's all we can hope for.
I think that's right. Yeah.
All right, Ryan. Well, thanks so much for your time this morning and all of your insights. 2021 was challenging. You had a successful year despite all that. And it sounds like that the deals will keep coming in 2021. So we look forward to hearing about all those.
Thanks, Ben. Look forward to 2021 with you as well.
Thanks so much, Ryan.
All right.